Events that led to Enron fraud include: in 1985, Enron was formed by merging Houston Natural Gas Corporation and Internorth Incorporated. In 1990, Jeffrey Skilling was hired and within 7 years was promoted to president and COO of Enron. From 1995 to 2001, Enron was named America's most innovative company by Fortune. The firm wins this award 6 consecutive years in a row. In 1998, Andrew Fastow was promoted to CFO. He then spearheads the creation of a network of companies to hide Enron's losses. On February 12, 2001, Jeffrey Skilling becomes CEO of Enron, replacing Lay. Lay remains a member of the board of directors. Skilling unexpectedly resigns on August 14th of that year, citing personal reasons, and sold large amounts of Enron stock before the fraud was discovered. Ken Lay becomes acting CEO. In October, Enron restates profits for the years 1997 to 2000. The SEC announces investigation into Enron's business dealings. Shares of Enron's fall following the announcement. In November 2001, Enron credit ratings drop to junk. Enron admits it's been inflating its income by around $586 million since 1997. In December 2001, Enron files for Chapter 11 bankruptcy. Its stock price closes at 26 cents. Perpetrators of the fraud include Kenneth Lay, who received a Master of Arts from University of Missouri in 1965 and earned a Doctor of Philosophy in Economics from the University of Houston in 1970. Ken Lay was the CEO of Houston Natural Gas when it merged with Internorth in 1985, forming Enron. He was found guilty on 6 counts of conspiracy and fraud and 4 counts of bank fraud. He died from a heart attack before he could be sentenced. Jeffrey Skilling. He holds an MBA in Business Administration from Harvard. In 1991, he became the chairman of Enron Gas Services. He was found guilty on 1 count of conspiracy, 1 count of insider trading, 5 counts of making false statements, and 12 counts of securities frauds. He was sentenced to 24 years and 4 months in prison and fined $45 million. Andrew Fastow. He received a BA in Economics and Chinese from Tufts University and an MBA in Finance from the Kellogg Graduate School of Management at Northwestern University. He recruited Jeffrey Skilling in 1990 and became the Enron's chief financial officer in 1998. He cooperated with the government's investigation and pled guilty to 2 counts of wire and securities fraud. As part of the plea, he agreed to a 10-year sentence and fine of $29 million. Richard Cauzy. Cauzy graduated from the University of Texas at Austin with a bachelor's degree in accounting and an MBA. He handled the Enron audits and later joined Enron as its chief accounting officer in 1991. He subsequently pleaded guilty to securities fraud and was sentenced to 5.5 years in prison and fined $1.25 million under the plea deal. And last but not least, Arthur Andersen, Enron's auditor who approved Enron's financial reports and ignored Enron's practice of avoiding write-offs through special purpose entities. What happened at Enron was management fraud, dishonesty, embezzlement of corporate funds, and illegal manipulations of the energy market. Enron misrepresented their revenues through 2 Securities and Exchange Commission approved accounting methodologies. They implemented these accounting techniques to make their financial statements pleasing for investors. Enron executives lied and fooled regulators to fake holdings off the books accounting practices. They reported profits based on the mark-to-market accounting system, which is not based on actual cost, but on fair value. The result was inflated income claims the company was not actually earning. The revenues were based on projected earnings. Enron used SPEs to transfer debts and troubled assets to holding companies so they would not impact Enron's financial statements. This allowed the company to understate its liabilities and overstate its income in their financial statements. Their accounting firm, Arthur Andersen, supported Enron's fraud. They did not let the audit committee know there were not proper internal controls in place to protect shareholders' interests. Arthur Andersen was earning more from consulting fees than actually auditing Enron, which pressured the auditing team to approve Enron's financial reports. Some lessons learned. Accounting firms should not be paid consultants and perform the auditing of a company's financial reports. This is to avoid conflict of interest. Revenue should be recognized when it is earned and not based on future projection earnings. How a company earns its revenues should not be hidden from investors. And to be professional and effective, auditors must be independent of management and evaluate the financial representations of management for all users of financial statements. How the fraud could have been avoided. There were two conflicts of interest. The fraud could have been avoided if these conflicts of interest had not been ignored. The first is where Arthur Andersen was being paid to provide consulting services and auditing. This led to Arthur Andersen supporting the fraud. If Arthur Andersen only provided auditing services, then the fraud could have been avoided. The company's chief financial officer was transferring Enron's assets to SPEs, and he was being paid commission from the deals. The conflict of interest was that he should have been working for shareholders' interests, but the assets transferred were financially benefiting him. Violations of internal controls include control environment. Management chose accounting methods to misrepresent their earnings and liabilities to the public. The accounting system. The mark-to-market and SPEs system did not report proper valuation of companies' assets and debts and resulted in financial statements with incorrect summarization of income and losses. Control procedures. There was a failure in separating the duties when the CFO was allowed to transfer assets to SPEs that paid him a commission. Financial implications of the fraud. Enron and Arthur Andersen companies went out of business because of the fraud. Thousands of employees at both companies lost their jobs and billions in pensions benefits. Enron shareholders lost $74 billion. Enron's stock peak value was $91 in early 2001 and had dropped to less than $1 by the end of November 2001. Major outcomes. Enron Corporation went bankrupt and 20,000 employees lost their jobs, insurance, and billions in pension benefits. Congress held several hearings about what happened at Enron. As a result, it led to reform regulations such as the Sarbanes-Oxley Act, aimed at greater corporate accountability in financial statements, which passed in 2002. The company lost its license to engage in public accounting in 2002.